Dr. Greenspan, thank you for being with us. We've had some encouraging economic reports, and markets are doing well over the past month. What's the outlook for the economy for the rest of the year?
Well, ordinarily, Al, we think of the economy affecting stock prices.
Right.
I think we miss a very crucial connection here in that this whole recovery, as best I can judge, is to a very large extent the consequence of the markets bottoming last March and coming all the way back. And you can see the whole blossoming of finance. Remember that it's the market value of equity in a financial institution that determines the ratings of its debt.
Right.
It's not the book value. And as these stock prices have gone up, debt became far more valuable, and you can see this huge issuance, especially of junk bonds, and a lot of these to marginal, less than BAA firms. And it's affecting the whole structure of the economy, as well as creating the usual wealth effect impact.
So what's the jobless rate going to look like at the end of the year?
I think the jobless rate will actually be hanging up not terribly far from where it is, because even though the economy is going to continue to rise, provided, I might add, that the stock market moves ahead of this.
Right.
But if that happens, you're going to get a significant rise in employment as we move into the year. But we are also going to get a rise in the labor force. There's a lot of people.
So the rate won't change much.
Well, the rate will come down a bit,
right.
But those who are looking for sharp declines are going to be disappointed.
Let me ask you this. Yields rose at 2 successive Treasury auctions this week. Does that suggest investors smell trouble?
It's the canary in the mine at this stage. The way I would look at it is the short-term outlook, and especially if the markets are working well, is one of increasing momentum. You can actually see it developing, very serious. But if the 10-year note and, say, the 30-year bond yields begin to move up, in other words, the 10-year note, if it begins to move aggressively above 4%, is a signal that we are in some difficulties. And what that is basically this huge overhang of federal debt, which we have never seen before. And it's going to have a marked impact eventually, unless it's contained, on long-term rates, and that will make a housing recovery very difficult to implement and put a dampening on capital investment as well.
So a bright short-term outlook, but a worrisome longer-term outlook.
That's exactly the way I would look at it. I'm very much concerned about the fiscal situation. Not so much the numbers, Al. It's the issue of the climate. One of the unfortunate fallouts from these huge amounts of monies we're putting in the budget and in the Fed and everything is $1 billion isn't what it used to be. I won't go discussing Everett Dirksen now.
Right.
But you can't turn somebody down who is requesting $20 million or $400 million in a project when you're talking about trillions.
Right.
And that adds up, and I think it's the culture. We cannot cut expenditures that I can see. I mean, we couldn't even cut the C-17.
If you can't cut expenditures and you can't raise revenues in a conventional way, in the past you've said a consumption tax ought to be on the table. Are you willing to go further now and say that we have to move to a consumption tax as a partial replacement for the income and corporate tax to address this problem you're so worried about?
I think that would be a short-term fix. It will work in the short run.
Right.
The problem, however, is very much the type of issue that Greece has got. We can find money to bail them out in the short run, but unless the underlying system contracts, the deficit contracts, it's just delaying the problem. So I'm not convinced by any means that we can succeed in stabilizing this longer-term outlook strictly from a value-added tax, because unless we come to grips with the fundamental issue, which is the fact that we have promised in the ways of benefits for Medicare, for Social Security, physically more than we have the assets to deliver with. So the economy can only grow so far. And right now, the claims on the real economy, forget finance,
Right.
are getting larger and larger. And it is not an issue just in Social Security, I might add. It is, it's money. You can always print money
Right.
and so on. Medicare is it's not a defined benefit program. It is one based on the physical needs of the population.
Right. I know you don't talk about current Federal Reserve policy, and we know that any final resolution of financial regulation is not certain. But from what you've seen in the House-passed financial reg bill and the Senate banking version bill, would it leave the Federal Reserve stronger or weaker?
Weaker.
It would. Does that concern you?
It does indeed.
And what would be the single act they could take to not leave it weak?
My basic problem is that people don't understand how important it is for the Federal Reserve banks in the districts,
Right.
how important they are to the functioning of monetary policy, supervision and regulation, and all of the aspects of a central bank. I'm concerned that if the Fed loses that aspect of its structure, we're going to find that what was originally the notion that instead of centering the central bank in Wall Street, which was the arguments leading up to 1913, it was decided to go geographically and spread it around. What is in the bills right now, in my judgment, reverses that process.
You have thought about bubbles a lot recently. Is there a bubble waiting to burst in China?
I think so. To be sure, there is significant bubbles in Shanghai and along the coastal provinces, but there's some of that going back in the hinterlands as well. And remember that the bursting of a bubble by itself is not a big catastrophe.
Right.
We had a dot-com bubble. It burst, and the economy barely moved. And the result of this is that it's hard to tell when that bubble bursts what the consequences are, because we don't have enough data on China.
Just in recent years, as you know, the euro has headed up, the dollar down. Is that changing? As the dollar's rally continue for the foreseeable future?
Well, this unfortunate issue is the fact is the dollar and the euro are both going down, if I may put it that way.
Yeah.
And since the exchange rate is a ratio, it's very hard to tell what the actual dollar-euro ratio will be. It went up this morning, obviously, with the temporary agreement, but both sides have got a problem. We have a long-term deficit problem, and the Europeans have the obvious problems that they're dealing with Greece and the other peripheral southern states.
Let me talk about your Brookings paper and speech last week. You say that regulators were not sufficiently vigilant, but it was almost impossible to see the calamity that was coming. And I think it's right to say that on monetary policy, you got it fundamentally right. Is that a fair summary?
I look back at our monetary policies and I say it could have gone wrong. It didn't. The problem, as best I can judge, on the fairly detailed analysis of the evidence, is that the roots of that crisis are very broad and geopolitical, going back to the end of the Cold War, and the massive changes in flows of funds, which brought long-term real interest rates down. And as a consequence of that, created a major expansion in capitalized values for real estate, especially residential real estate, across the globe. It's hard to... there are certain aspects of monetary policy which probably had some effect, but clearly it was minor as best I can tell.
Well, Janet Yellen, who's the head of the San Francisco Fed and likely to be the new vice chairman of the Federal Reserve Board, said, and I'm quoting, higher short-term interest rates probably would have restrained the demand for housing by raising home mortgage rates. Is she wrong?
I think so, because we tried actually to do that in 2004, and we ran into what we called the conundrum, namely, for decades, every time the Fed raised its short-term rates, the 10-year note, which is really the proxy for mortgage rates, the yield went up with it. This time it did not. And the reason it did not is you cannot have the 10-year note yield determined both by arbitraged global finance and individual central banks. And as a consequence of that, what is easy to demonstrate statistically is that starting in the period where the sensitivity of the early stages of the bubble building up, so to speak, it was very clear that what was determining the rise in prices was long-term, the movements in long-term mortgage rates, meaning going down, not the federal funds rate. And indeed, when the federal funds rate was purposefully put down in 2003 to confront what is similar to what's going on today, namely the deflationary processes, long-term rates did not come down. And that, as far as I can see, the general notion is just not supported. The general notion that the Fed was the propagator of the bubble by monetary policy does not hold up to the evidence.
On another matter, you also said that the proposed systemic risk regulator is not a very good idea. It will almost certainly miss the next financial crisis. Critics would ask, I guess, how could they do a worse job than the current system did?
They wouldn't. But the problem is that's not the answer to this issue. It's very evident to me that the underlying crisis was caused by what is clearly a once-in-a-century event. I mean, we have had almost no instances of short-term credit being withdrawn on a global basis the way it happened right after the Lehman bankruptcy. So all of the individual evidences here is that this is a very rare occasion.